Okay, okay. Hello, 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 hello. Yes, can you hear me? Hello, good evening, everyone. Andre, can you hear me well like this? Even closer. Okay. Okay, okay, okay. Please take a seat. Front row seats are still available. They're selling fast. Hello, hello. Please take a seat. Grab the last drinks. It's going to be so exciting. You're not going to have time to run to the bar. Okay. Rui, please also take a seat. Welcome, welcome, everybody. It's my great pleasure to welcome everybody here on behalf of Obligate for the first ever Obligate Open in that we're launching here in 2025. It's great to see. Yeah, thank you, thank you, thank you. It's great to see so many familiar faces, friends, shareholders, partners, clients. Real pleasure to everyone here. Of course, the Obligate team as well, and the organizing committee who have done a fantastic job in making this possible. And it really reminds me that we're not just creating a company and building a company here, we're really shaping an industry. So for tonight, we have actually a very attractive schedule, and I'd like to give you a quick intro to that before we start. So reflecting very quickly on our recent successes. So with Obligate, when we started and went to market 2 years ago, we could not have imagined what we have achieved in the meanwhile. We have issued over $100 million worth of natively on-chain securities, such as bonds and structured products, on a regulated platform here in Switzerland. And we have executed on our vision to really bring traditional financial infrastructure onto blockchain rails. One example, for example, is the most recent issuance with a American airline, startup airline, who have raised $15 million via our platform successfully in the past months for growing their business. So this is real money for real companies on blockchain rails. Q3, I can already proudly say that tonight, will mark the most successful quarter in history of our company. And we are going to announce soon the closing of our most recent fundraise, which will give us fuel for the next phase of growth and partnerships and developing the ecosystem. So for us, it's so we may not be the loudest in the market, even though we've improved with a very good marketing team. But for us, leadership in this industry is about execution, trust, and building the bridges, not just between us partners, but also between TradFi and DeFi. So that's why I'm very proud to be welcoming tonight 4 of our close partners, because of course we couldn't do it alone. We'll have Fatih on the panel representing Signum. I guess everyone in here knows Signum Bank, but we're partnering with them on distributing our products, our real-world assets to real people. Thank you very much. Then we have Philip from Solana Foundation. And Philip, we're partnering with on our exciting infrastructure for on-chain structured products with our Margarita Finance brand. Thank you, Philip, Philip, Philip. Then we have, of course, Gen 2, which I will introduce separately later on, which is we're working on as a securitization or assetization partner, how they would say, bridging TradFi and DeFi. Thank you, Philip. And then we have Bernhard representing Canton, our most recent partnership, which we're going to announce very soon, I guess one of the leading institutional infrastructures for blockchain applications, bridging privacy and interoperability. So whilst the panel will talk about topics like liquidity, regulation, interoperability, there's also going to be some competition tonight. Yes, you've all heard it. We're very excited to have later on upstairs on our beautiful terrace a ping pong tournament. Ping pong for me is the perfect metaphor for our business. Speed of the market matters. So you miss 1 point, you're out. Precision and timing. It's not a matter of how hard you hit it, but how precisely you hit the ball. And of course, ping pong you don't play alone. There's always partners and competitors out there. So it's really like our business, a balance of speed, precision, and partnerships. And maybe we're going to see you bringing home our beautiful trophy tonight. So finally, I'd like to close here and thank everyone for your trust, your support, and of course for coming here and supporting us tonight. I'd like to thank the team around Tatiana, Tobias, Sam, Oscar, Linda, Shin, and of course also Stefan, helping and supporting and making this event possible. And then, of course, I'd like to thank our hosts at Gen2 for making this possible. So I'd like to give the word very briefly to Philippe, the CEO.
Hello. Hello, everyone. Beautiful to have you all here, so many of you. You are the proof that there is lots of opportunity in the financial markets. I would even say that Obligate and Gen2 set the proof to that, but I'm sure there's lots more to discover with you all tonight. It's an unprecedented time, you know. In finance, the opportunity has never been bigger because all these old structures of big corporates under their regulation that can sell whatever they want to any investor is finally coming to an end. The market is changing, and that is the opportunity for everyone. Every one of you can participate in assetization. Every one of you can participate through tokenization or securitization, in whatever you like. But you have to be aware of that, and I hope tonight will be a statement to that cause, to that vision, and you all not only win in table tennis, but also in life and through finance and in investing in your beliefs. So thank you for celebrating that with you, and certainly a big applause to Obligate for arranging this and having a great night.
So I'd like
and
to...
last but not least, everyone can get an assetization book, and you're happy to also get them signed by me if you like.
Don't miss out on that. He's going to be very famous very soon. No, but just in terms of admin, please help yourself to a drink. We'll have the panel today here on this stage, and then we're going to move upstairs to our beautiful sunny terrace later on for the dinner, drinks, and the tournament. Okay, so I'd like to welcome the panelists on stage and Tobias, our Chief Business Officer and Deputy CEO, who will be guiding you through it. Yes, find your picture. That's going to be hard. Maybe. So we already have a mic. Okay, I'll give one in the middle. I think you sharing is caring.
Okay, good afternoon as well from my side. To the panel, we'll be talking a bit about real-world tokenization, actual use cases. My name is Tobias. I'm Chief Business Officer at Obligate. I know all of you are here actually for the ping pong tournament, so I'm sorry that we will bother you with this panel in between, but I'm sure we will be a great warm-up to the sports activity later. Tokenization has been a big topic for a while. It has been hyped. Many people talk about it, but there are also lots of things being said, very broad definition. So today, together with the panelists, we want to talk about actual use cases and where is tokenization delivering value today and driving the market forward. So I want to start with brief introduction to the panelists and some initial statement they can make. So Matthias already did a short intro of the panelist. I will start with Fatih. She's head of tokenization at Signum Bank. Led many groundbreaking projects there already on the tokenization side, from tokenization of funds, stepped instruments, and as well art, right? So from all the projects you have done, what do you think is what illustrates the best where tokenization brings value to your clients?
So first of all, thanks a lot for having me. And the question is like, if you would ask me which child I love the most. So I think every project showed in its own way the advantages of tokenization, right? On the Picasso tokenization that we did a few years ago, it was all about fractionalization, liquidity. On the debt side, it was more about giving access to a new asset class. On the private equity side, it was about efficiency, so we're able to reduce the ticket sizes to 1,000 Swiss francs, for example. Yeah, I think we had a lot of interesting projects with big and strong partners, and we showed with every project the advantages of tokenization, the beauty of it.
Great, thanks a lot. So we are also joined by Philipp von Moos, currently CFO of Solana Foundation. He previously worked as well at Bitcoin Swiss, worked on the crypto custody solution. He has quite deep expertise as well on the traditional finance side, as well digital assets. So Philipp, based on your experience, do you see a shift now from clients, how they approach tokenization in the recent years?
Yeah, so when I started, it was 2017. Everybody was talking about tokenizing everything. Now we're many years later, and we're starting tokenizing some things. I think the big shift, there's one big shift, like on the commercial side, which is there's business cases that start working. So asset managers, for example, realized it's an additional distribution channel. I think a big wake-up call was BUIDL when BlackRock launched their first tokenized money market fund, and today it's 2 billion AUM. That's also a big number for BlackRock. So I think it's not just these pilot project, POC, small project teams of crypto nerds within a bank or somewhere, but it's viable business cases that are working.
Thank you very much. Then moving on, joining us from Digital Asset is Bernhard Elsner. He's a Chief Product Officer and one of the driving forces behind the Canton network. He spent there the last 7 years building the technology and product side. So Bernhard, Canton is all about interoperability, privacy. Why are these such critical things when we talk about tokenization?
Thanks, Tobias. Yeah, where my thinking has shifted a bit over the last years is that I used to think about tokenization as, creating, I would say, new assets on chain, right? Be that new sorts of bonds, be that private equity and similar. But I think what sunk in eventually is that the crypto space and the blockchain space, as successful as it is a drop in the ocean, right? At now $3 to $4 trillion, it's less than 1% of the total outstanding quality assets out there, 400 trillion plus. So really, I think the big unlock is not so much to try to create new assets, but to move those quality assets that are driving the capital markets today onto new rails where they can be successful. And for that, really, privacy and interoperability to me amount to viability and utility. Viability because those $400 trillion of assets already have privacy, right? If you think about like a sort of a product that is sort of systemic to the global capital markets like US Treasuries, every institution that uses those assets relies on the privacy of those, and they won't move to new rails if they have to give up, the privacy of their day-to-day trading and business operations. So if you want to move, to digital assets at scale, privacy is really a threshold issue. And I also believe that, once it's there, there's no going back. Even Satoshi knew that transparency of blockchain networks is ultimately bug, not a feature. But we've also learned the hard way as an industry over the last years that putting tokens on chain alone doesn't yet create value. Right? Really, what the templates that the public networks like Solana and Ethereum has shown us is that the real value comes about if you have an open ecosystem of assets and services. And that's true for traditional assets as well. Like just putting cash or a bond on chain doesn't really get you any liquidity. What you need to do is to give some stakeholders in the industry a net new capability. And I'll talk about that in a bit. For example, managing their liquidity 24/7 based on reserve assets like US Treasury, stuff that's simply not possible today.
Thank you, Bernhard. So finally, we have Mark from Gen2 Digital. His background is in structured products and trading, and he's now focusing on making assets bankable by bridging traditional world with digital assets. So Mark, Gen2 has securitized by now over 6 billion assets, I think. Can you share an example how securitization solutions can be a catalyst for tokenization?
Sure. Everyone, welcome to our beautiful offices here. It's a pleasure to have you all here. When we think about what Gen2 has done over the last 7 years, we've securitized about 8 billion total. We currently have about 6 billion total in assets under service, which is a really big feat, I think, in terms of what we've done. What we've done is we can unlock assets that were previously inaccessible to the market, right? So we do that very simply by a securitization process. So if I give you an example, right? So if we look at, I don't know, a private equity kind of fund or even a late stage growth company, only the initial investor gets access to that kind of company. There's very little liquidity out of that. But if you put that into an AMC or a tracker, like what we do, if you put that into a securitized vehicle, that gives access. The problem here now is if you add tokenization to this, you create the hypersonic rails for liquidity, right? So you create true fractionalization. You create a settlement layer that is instant, and you create real rails for liquidity on this side. So once you have tokenized, look, we've done 230 billion in tokenized cash, USDT, USDC, are the two. Then we're moving into private credit, 17 billion, tokenized bond funds, I think are about a couple of billion, as you mentioned. So things are really moving quickly. The next stop's going to be public equities, which we're seeing with backed finance and Kraken. And we're going to see private credit as well. So we're definitely moving up the risk curve, as I keep saying, because people want more risk, at least want more return with commensurate with that risk. But if you tokenize something like an AMC, or if you tokenize something as private equity, you actually get access to something that's previously completely inaccessible before. And that's game-changing in this industry.
Yeah, so moving back to Fatih, where do you see the most traction at the moment when you look at your client base when it comes to tokenized products?
So on the one hand side, our clients are interested in liquid products, so tokenized money market fund, is there an option? Then on the other side, they're looking for yield, and we speak here about private debt instrument, for example. But in the end, I think our clients are interested in good investment opportunities, and this is independent of if it's tokenized or not, so briefly said.
And Philip, next question to you. Obviously, Solana is has an active community ecosystem, right? Do you see people moving over from just trading crypto exposure to also now tokenized products?
Well, I think it's two different things. There's one, or maybe even three. There's the crypto as a speculation token, as meme coins, all these. There is crypto as financial infrastructure, where, like Ethereum, Solana, other tokens that are used to build rails and infrastructure for other tokens to live on. And then the third are the tokenized assets, bonds, etc. And I think what we've seen over the last years, and still ongoing is like a lot of innovation with the meme coins and everything that you can trade on chain. You can like put a token into a protocol, leverage it with one click 10 times, and get that token again and use it as collateral on another trade. So all these things is like happening very fast, possible on meme coins, for example, and that type of financial infrastructure, which comes with additional utility. Bernard mentioned it. You can have different utility and at different scale when it's on chain. And I think the funny internet money is the lab, and a lot of innovation is done. And now, but the rails are tested. I mean, you can say it's funny, but when Trump coin launched on that day, 35 billion were traded on decentralized exchanges, and the chain just worked. The infrastructure worked. So it's with these, well, more or less funny tokens testing the infrastructure, and now it's ready for other assets.
Moving back to more Mark. So we both worked a lot in structured products, right? How do you see as well, if we look at what we do under Margarita Finance, the place for structured products, right, on the blockchain?
Yeah, look, structured products. A few years ago, we tried to do it on chain. I used to be at Merrick's. It didn't really take off. We didn't see a lot of demand for this stuff. Now it's coming to a fore where you can start looking at actually building native structured products on chain. I'm not just talking about private placements, for example. I'm talking about traditional exotics on chain, stuff that Margarita Finance does very well: the barrier reverse convertibles, the autocallables, the airbag certificates, all the kind of exotics that traditional finance players love. These things are changing the game. I think there's demand coming out of Asia, there's demand coming out of Europe and America as well for these kinds of products. So what's going to happen now is we're going to see the hyper-customizable options that are going to be available to investors to play in. So a family office that wants to do a very bespoke product with a very specific risk and reward type yield product can actually do that now. And that's kind of but you still need the securitization, kind of the back-end infrastructure to make these kinds of things work, because we're still not there when it comes to native issuance on chain. And so we still need, the construct where we have these TradFi rails and these digital rails to work.
Yeah, moving on with Bernard again, another question for you. So you work on also many interesting use cases with institutions, larger institutions who use the Canton network. Can you share some more insights of that? I think you mentioned already some initial thoughts.
For sure. I'll tell you the use case I'm most excited about is something that sounds about as boring and mundane as could be, which is on-chain repo trading against US Treasuries. But I'll tell you why that is so exciting, right? So what is really the backbone of DeFi right now, right? It's the stables. They are sort of the ultimate sort of way you transfer value between venues. For example, if I want to switch between Ethereum and Solana, I most likely go via a stable. That's where I park my on-chain liquidity. That's why stables are so hot. But if you think about how stables work, on the back end of stables, they are completely backed by traditional rails, by US Treasuries and by fiat. So, if you are a large-scale crypto trader, right, you need to manage your liquidity mostly, sort of in things like stables. But what if you need a whole chunk of stables on the weekend, right? You can't, because you can't move the treasuries or the liquidity over to Tether and Circle to actually make it happen. So there's a real impedance mismatch between these two worlds. So here we have a stakeholder set, in the crypto trading space, the sorts of people that market make for Trump coin, right, that have one foot in the crypto world and one foot in the traditional world, and they really feel the pain that the traditional world doesn't move with the same liquidity as the crypto world. So we did a world first recently with sort of an industry working group all the way from DTCC, Bank of America, TradeWeb to crypto traders like Cumberland, a weekend financing trade between on-chain US Treasuries and USDC, basically unlocking that capability, to that point of new utility of actually managing liquidity 24/7. Huge unlock for them. And I deliberately say here on-chain US Treasuries, not tokenized US Treasuries, which to me is a really important distinction. Because you can bundle up existing assets like sovereign bonds and similar in a tokenized money market fund or some other vehicle, but it's not the real deal, right? It's not the reserve asset that is risk-free on regulated institutions' balance sheets. Whereas, with this sort of, especially, that sort of viability property of privacy, we have managed to work with the prime brokers and the CSDs in various jurisdictions to actually construct on-chain versions of these traditional assets, so that suddenly you can really have the traditional finance, the back end of the stable coins, and the financial innovation, the stables and the protocols on venue interacting 24/7. And to your point about, yield, sort of my vision of that confluence of TradFi and DeFi is always, imagine you could hold like a risk-free reserve asset like US Treasury, but then park it in a lending protocol like Aave and generate some extra yield. I think those are sort of really compelling products in the future where these two worlds come together.
Sure, yeah.
Yeah, just to continue that discussion there, sorry. Yes, I agree with this for the most part of it, but I think when we start looking at public equities on-chain as well, I think we'll see crypto natives like vol, they like yield, and so they'll start looking at how you can borrow against public equity because it's a lower vol asset. At the end of the day, people want to borrow against a yielding asset or a low vol asset. So that's kind of what we're moving towards now. So yes, I see things happening, but we're going up the risk curve because we still want a lower vol.
I 100% agree with that, right? But I also make the distinction there that you can approach public equities two ways. You can issue net new things digital native on chain. But again, I take the lens, what if you could actually mobilize all existing public equities in a market to be mobile into an on-chain venue so that you could move your Apple stock, your Microsoft stock, your Tesla stock on-chain and suddenly put it in a protocol. That, to me, is the unlock at scale.
Yeah, I think it's, we will touch on these points later again, how to actually design tokenization in the right way so it can actually bring value, right? Going a bit into, okay, we are very proud to work with all of you on many exciting projects, so we can spend a few minutes on that. Philip, with you, with the support of as well Solana Foundation, we started the Margarita Finance project, started to work on structured products. How do you see that space developing, and where do you see the value this brings?
Yeah, what we see currently, what is really in high demand in all DeFi land is high yielding tokens. Like get a bit less of the less volatility than the tokens I was talking before, but still having like an attractive yield, obviously above risk-free rate. And what we see is like a lot of tokenization protocols have traction when they get when they're able to offer a yield that is somewhat over the borrowing rates, but still kind of at a reasonable risk, because then all the utility of the DeFi and the ease of use comes in, that you can quickly like leverage your, let's say you have an Apollo private credit fund, triple or AA rated, pays you 7%. You can borrow on chain for 5%. So yeah, why not like leverage up once or twice, 1-2x, just for a few days, hours, however quick it will be. It's not like the in and out and ease of use is so much easier than calling your banker. Sorry, there are probably some bankers here, but it's just the speed of it is so much faster and it's so easier accessible that like these type of tokens, we see a lot of traction that yeah, when you can have a higher yield in the borrow rates and then leverage up.
So Fatih, with you, we work on new opportunities for your clients in mostly private debt space. How do you see that segment and the products that we can bring for your clients?
So some might say that we are competitors, but I would say that we are very early in this industry. So I really like the partnership that we have, that we can exchange, to see what kind of pipelines we have, to see also where the demand comes from. So I really think it's important that we team up and to, I think now tokenization is more about distribution, right? And if we can join forces and bring these kinds of products to investors, I think then we have done our job.
That's correct, yeah, and we're very excited to soon launch further products together. Yeah, that's correct. And Mark, I think with you guys and Gen 2, we work on some interesting projects as well in bringing some innovation to through the vehicles that you provide. Maybe you can share some points around that. Yeah.
I mean, for us, it's very much about symbiosis and symmetry, right? So with Gen 2, we are very good at the legal structuring, the financial engineering, as it were. So we can create the certificates, the securities that TradFi knows and loves, right? Because they exist on custody networks, they exist on TradFi rails. But with Obligate, we have a different channel for distribution, right? We have a digital market infrastructure with Obligate and with Margarita Finance that kind of changes the game a little bit for us, right? So it expands distribution, it looks at settlement that is absolutely immediate. And for us, it's symbiosis, right? Because it makes sense. So for us, you as Obligate and Margarita are a technology enabler for us. And it's very helpful. We are the securitization agent behind any tokenization agent, really.
I want to move a bit back to the controversial topics that were discussed earlier. No, you guys can decide who wants. You can all comment on that. But I mean, you all work on different segments. But where do you see the most adoption coming in the mainstream? Right? Is it banks, institutional investors, funds, retail investors? Like, where do you see will be the driving force behind tokenization?
I think it really happens at both ends of the market. You know, we've got, I would say, you know, that traditional DeFi and crypto clientele, which is driving a lot of the I would say, the financial innovation, right? New asset types, things like fractionalization, the innovative protocols, and that will continue, and it's super exciting. But we're now seeing, I would say, a new wave of real interest in the in the institutional space, all the way from the central banks to the CSDs, to actually sort of close that link. And I really see sort of more, I think, an increasing confluence of the two worlds, right? I think something that's always sort of, I would say, been my little itch is that the traditional markets, which is our traditional foothold as a company, and the crypto markets have always felt like two worlds with very sort of thin rails sort of across them. And I think as that gap closes, we'll sort of address that sort of middle ground of institutions, you know, that already have one leg in each foot, but has a really sort of cumbersome time right now, right? To maybe get to your point, you know, right now you're structuring products to put on chain, where again at the back end everything is on traditional rails, right? Where I see the future is that you can actually manage your whole value chain on the same venue.
Everyone agrees, or any controversial thoughts?
Yeah, I think it depends also on what products and what are the use cases, and on, I would say, like as of today, like a lot of it is driven on Solana on retail. On Canton, it's just a different, as of today, like a different user base. But in the end, it comes together to like the bigger the client and the more professional, I would say the more like it needs to be regulatory watertight, otherwise they don't tap into it. And then you know, if you're a retail, maybe you want 1 or 2% more. If you're Citadel, maybe you have so big volumes, maybe it's okay if you have half a bit more. So I think it's it depends on the very much on the product itself, but that as the regulatory clarity comes, and also as like first movers come in and others see it works, and I think the ones leading the adoption right now is really like hedge funds, just those that are very sharp, also very technical, right? They're usually like most of their team is like quants and developers. Those are moving a lot of money. And they are very active on DeFi today.
Yeah, and also it was also in many discussions before we started here. The big topic is liquidity, right? Like many products claim now 24/7 liquidity, but underlying instrument is actually not 24/7 tradable, right? So how do you see that point? How can tokenization actually deliver on that promise of liquidity?
Maybe I'll start on this one. It's a double-edged sword, I think. So if you say, if you're trying to raise equity and you can't, and you're trying to raise debt and you can't, if you think a token is going to give you magic liquidity, it's not, right? So just because you create something out of thin air, as long as it's backed by something, doesn't mean that you're going to get liquidity. It's just it's a false promise. It's a false paradigm. It doesn't exist. I think what blockchain has always promised is the settlement side, which I think is amazing because you don't need, it's a trustless network, and that makes things very, very interesting for us. Look, I'm a crypto native, I'm a Satoshi believer, I'm all of that stuff, but I think the arbiter of truth here is going to be TradFi. Look what's happening in the US, right? Love him or hate him, Trump is moving mountains in this space. We have a Clarity Act, we have a Genius Act, we know what stable coins can do. We know what reserve backings are like. In 2020, they removed the reserve backing in banking in the US to 0%. In Switzerland, it's 4%. So these things are moving with regulation changing. That's what's going to work. Right, so we have institutions that are bringing ETFs. Just on Bitcoin, we have decentralized. Sorry, not decentralized. We have digital asset treasury companies now, but they're all going to be based in the U.S. Unfortunately, for now, hopefully it changes. But as regulation changes, as TradFi comes in, they're going to be the ones that are the big arbiters of truth. I think we were talking about. I think I was talking about Linkor Bank earlier today with Felix about this, and we were saying, listen, what happened with tokenized yield funds, right? BlackRock was the clear winner here, right? Now we have ETFs, we have DATs coming through, and they're the ones who are choosing who's going to be the winner. Is it going to be BTC, ETH, or Solana, or Ripple, or Cardano? Sorry, but these things are they're going to be the arbiters of truth here, and regulation will move custody down a certain path, and it'll become a zero-sum game, almost a zero-sum game, where custody becomes very cheap because regulation is moving technology in this way. So much as I love the Satoshi kind of morale, I think it's changing because regulation is changing in favor of institutional adoption.
Yeah, I think you could even say, as of today, tokenizing something is not that difficult. There's many very professional entities that can do that. But bringing liquidity in it is still the tough part. But then when you look at like the average SPI company, like how liquid is liquid, right? There's also market maker that provide a base liquidity. But with a permissionless open network, it's just the vast potential because theoretically everybody with an internet access can be on the other side of the trade, right? And what we've seen is X stocks, which tokenized the largest 60 NASDAQ stocks on Solana. A lot of buyers of that online were like just in regions like Southeast Asia, which is very hard to buy and get access to US stocks. So I think it's just the reach is so much bigger so that that liquidity can come in. And I think where DeFi can also play its strength is not necessarily on the Tesla stock to bring more liquidity, but in less liquid stocks to have like some kind of liquidity. Like even if it's like for a company, own company shares that are not listed, that you can create an internal market or a way, a system put in an AMM and an automated market maker to have some kind of liquidity. AMM are definitely not the best way to trade like very liquid stocks, but for certain stock or for certain assets, it's a great way.
And what about the risk? I mean, we see now every week or so a new layer one is popping up, right? And some assets are on this chain, assets are on other chains. What about the risk of these fractionalized markets, right? You have these island solutions, right? How should we deal with that? Maybe Bernhard wants to comment on that.
Yeah, I mean, I'm fairly opinionated on that. In that, I see the value of on-chain rails and ecosystems play out in very distinct venues. I mean, Ethereum and Solana, without a doubt, is where DeFi is happening. I think a lot of the L1s that are popping up are very tactical measures, commercial reasons behind it. I think we'll come back to a consolidation of some sort in the foreseeable future. Because I mean, I started sort of saying, privacy is the viability, profitability is the utility factor. I think moving single assets to their own individual chains, be that the sort of the Circle, the Tempo, the Ondo chain, will actually undermine the utility of these assets. They ultimately, we've seen that in the institutional space with all sorts of attempts to build sort of payments chains which only contain cash assets, or sort of chains that have only specific sort of institutional assets on it. I think all the rhetoric over the last years that this will all be glued together with bridges and messaging and all things. There's no proof that that works, right? So I'm a strong believer that actually Solana has been opinionated on this from day one, has said we're building a monolith where that interoperability that makes DeFi works. And I think they have proven out that that's the recipe. And we similarly are of the opinion that real value creation will play out in layer chains where there's a lot of activity that creates whole value chains on chain. And I think there can be a number. Some may be more focused on the consumer distribution, maybe some more focused on the institutional, but I really do believe that creating lots of L2s and L1s and sort of having single asset chains is counterproductive in the long run.
Yeah, I also agree with this. I think there's a huge, look, I believe in experimentation, right? So when we build technology, we have to experiment. When we build new products, we have to experiment. And so I think we're going through the genesis of experimentation here. It's a wonderful thing to see. But if you're building a layer 1 or a layer 2, you need liquidity to come on chain, right? And the first thing you do is stables. Yes, everyone talks about bringing real-world assets on their layer 2 or layer 1 because they need to bring activity on chain. But the first protocol is going to be stables. And this is what's happening in the global south, right? We have a dollarization of the global south. Why is that? The US represents 40% of all capital market activity around the world. That's a big deal. And so they have only interest because it projects the US dollar hegemony of US treasuries. They create demand for US treasuries. So for me, that's a big deal. We will have more assets on chain. The future will look like native issuance on chain. I'm sure that's going to happen in the next few years. Is it going to happen next year? Probably not. But we have to go through regulation to get this stuff done. And the reason is very simple. We spent the last century doing securities law. This is banking. We're in Zurich. There's banks everywhere here. Everything's done according to securities law. We just can't suddenly make up tokens and say that securities law does not apply. It doesn't happen that way.
Exactly, and in Switzerland we are very fortunate to have a DLT Act, right, which allows to create securities natively on the blockchain. So Fatih, how do you see this Swiss aspect in terms of tokenization compared to other jurisdictions? Do you see the value of that we have here when you speak with your clients? Because we both use a similar framework.
Yeah, yeah. So first of all, I'm not a lawyer, so yeah, regulation is very important. I think back then Switzerland was really a first mover, but seeing now what is happening in the US, for example, and other jurisdictions, I think we need to catch up a bit. So we have the DLT law in place since a few years, but nothing happened really since then. So I would appreciate if we can move forward, for example, on the stablecoin side. And yeah, I think we need to catch up and not to fall back.
Any more comments on this, or?
Mark is always happy.
Sorry, I do talk a lot, so okay. On the stablecoin side of things, I think, yes, Switzerland does, look, I'm not obviously from Switzerland, I'm Canadian and British, so I'm very different here, but when it comes to stablecoin issuance here, I think your laws need to change. Because it's all about fully backed. You need a banking license. This makes it very difficult to issue stable coins. That got to change at some point in time. But the DLT Act here is pretty amazing. You can do native issuance here with equity. We've seen that with Axie and Ariat. They've done that. It's an amazing thing to happen. I think even backed finance uses that kind of legal loophole to do X stocks on chain, and they can transfer it to retail. So there's a lot of legal reckoning that's happening in the space right now, and Switzerland's at the forefront. So as much as everyone seems to think that we are slower here in Switzerland, I don't think it's as bad as people make it out to be.
Well, in my current job, I see like a lot of jurisdictions, and the DLT Act was 2021, was really cutting edge at the forefront, but then it stopped. And like today, if anybody thinks Switzerland is a great crypto place, it's not anymore. For new companies that build, it's just not. Like Middle East, US, they're just running left and right. Yeah, they just run ahead, full steam. And Switzerland is, I don't know, sitting, waiting, but I don't know, but it's not moving. Sorry for the party pooper.
It's fine. So maybe before we come to some questions from the audience, we do a quick round for everyone. So if we look ahead 5 years, where do you think we stand in terms of tokenization? We start with maybe Philip.
Yeah, I think it's this type of like where the curve is going to be very steep, and then it's like it's very hard what's going to be in in 5 or 10 years, because it may be that we're like 10% higher than we're all like volume-wise, 10 or 20% higher in 4 years, but then 10x in 5 years. So I think on like a lot of existing rails will be replaced, especially on the payment side. And the thing is, what we haven't talked about, but like we talk about payment and stablecoins, right? But then basically the stablecoin was like the first real world as a tokenized token. But then why not have a money market fund instead of a stablecoin and then use it for similar purposes? So I think when we include all the stablecoin and stablecoin plus interest in this equation, then I think we're just going to see explosion already in the next 2-3 years.
I'm still thinking what's going to be in 5 years.
Look, I think we're moving up the risk curve. As I said before, I think we're going to move into private credit. It's going to come on chain. Currently about 17 billion there now. I think it's going to expand a lot more. I think we'll go into slowly native issuance. I think regulatory landscape will change across the board. There'll be unified regulation happening from the Middle East under VARA, which I think is still not very good. It'll happen in Australia, happen in Asia, specifically in South Korea, because things are moving very rapidly on that side. The US obviously is the big elephant in the room because they move at a rapid pace because of existing government. But keep in mind that 4 years ago, under the previous government, there was no movement in crypto. So it needs to be political.
A lot of companies move and build, but they just had the uncertainty and didn't launch. Like a lot were building in the backbone, but they will kind of not talk about it anymore and stop launching if the winds turn.
I'm going to lean out a bit of the window here and say, we still talk about, tokenized assets and traditional assets. And I think over 5 years, we actually have a chance to switch that rhetoric completely and simply make the distinction between sort of, is it traditional rails or blockchain rails, right? If you think about it, you make payments day to day through, SEPA and Swiss Interbank and Twint. You always just consider it cash, right? Oneness of money. And I think long term, we need to take the same lens, with blockchain networks. As long as we sort of make a clear distinction between, well, there's stable coins and there's real money, right? We're really gonna have this two world picture. And I think, with all the momentum that's happening right now, I agree completely. There's going to be really big uptick. But with that, I think that boundary between what is a crypto asset versus what is the real world asset will increasingly disappear, and we'll just sort of talk about basically over which rails our transactions flow.
Should I say something? Okay. So I agree with Mark. You said that we will move along the risk curve. This is also something that I believe, and you said we started with tokenized cash and money market fund. I think we will continue. But I believe that the traditional world will still exist. So it's going to be like two worlds, the on-chain and off-chain world, but this will then converge. But I think in 5 years from now, we'll still be building. I think the volumes will be bigger. Yeah.
Great, yeah. So I think we have a few minutes for some questions from the audience. If there are any, please don't be shy. You're happy to.
The question is for you, Mark. Thanks for the panel, by the way. What's Gen 2's role if we now assume, like Bernhard said, that everything will anyways be tokenized natively?
Sure. I don't think we're there yet. I think we're a long way from there because we're dealing with MiFID securities here, yeah? So we have to deal with privacy. We still haven't figured out privacy on chain. Everything is not yet fully private. You can do things on Monero, but that's going to be illegal because you can't do money laundering. So we exist for a reason. We make assets that were previously illiquid, more liquid, and we create the liquidity rails for it via Gen 2. That's what we're good at doing, and we've got the proof is in the pudding, right? We've got 6 billion that we've done over the last 7 years. Even now, before you can tokenize any real-world asset, before it was called a security token, now it's called a real-world asset. We've been trying to do this since 2017, right? Hasn't worked. You still need the legal infrastructure, the custody, the banking rails to exist before you can create a digital twin. Even if it's cash, think about what's happening with digitized cash, or even, Signum's launched their own stablecoin as well, and so it's all backed by something. You need that to exist, right? The TradFi rails is what we're very good at doing, and we've done that over with 1,600 different clients, right? So we're good at that part. We're the financial engineers. These guys are the innovators here when it comes to technology.
I would also argue that even if you no longer need the traditional custody system, but do it on chain, you still need the financial engineering and the sort of regulated institutions to do the structuring, the issuing, and so on, right? I think ultimately for me, new rails just means a new technology layer underneath. I don't believe the regulatory and sort of organizational structures of the markets will shift that fundamentally. Maybe a few roles in the market will become redundant or less important, but really I think the technology is now at a point where a lot of traditional finance can happen on chain without too much regulatory change, which is also why the regulators are now sort of making these incremental moves to make it possible.
Thanks.
One thing I will say on this is that we have FMIs, which are financial market infrastructure, and soon you will have digital market infrastructure as well, which I would put Obligate and Margarita there too.
Yeah, if I can comment on that, I think exactly this goes in the direction what we are working on together, right? Replacing individual elements of the value chain with new rails, and looking at how to make the process more efficient, access new markets this way.
One question to Bernhard. Basically, can you give me or us a little bit of view of Canton Network? Because in the beginning, your first statements, they were kind of challenging, and you were not happy with what could be reached or what has been reached. Maybe I just misunderstood it or something. But where do you guys want to get with the tokenization setup, and maybe what you want to improve, or but realistically, just to give us an overview.
Yeah. So really my North Star there is always to just take, the biggest, most important assets in the world, right? US treasuries and actual US dollar, and think through what would it actually take to get those on blockchain rails, right? And, Matthias already said rightly, privacy is one of those. There's just no chance the traditional custodians, prime brokers, CSDs will make available native US treasuries on chain without privacy properties that mirror the traditional markets, right? That's why I said earlier that's sort of the viability side. But there are other properties involved. I always, make this example. Imagine I wanted just those two assets on chain, right? There are government mandated sort of monopolies here for sort of the Federal Reserve and, the sort of the DTC to manage the registers essentially for cash and assets, right? So if you think about bringing them on chain, right, they'll say, okay, I can bring my asset on chain, but I need total control over settlement and finality. So basically, I need to be like the big validator here, right? So you end up with something like a fairly centralized chain. And then the other entity comes along and basically has the same demand. But now you suddenly entangle them in a really awkward way, right? Where one government monopoly, the central registry is dependent on the Federal Reserve for settlement and finality and vice versa. Just doesn't work from a regulatory point of view, right? They can't uphold their regulatorily sort of mandated controls by just jumping on a traditional blockchain in that sense. So we've, over more than 10 years, built a protocol, a DLT protocol, where these institutions can actually bring their assets on chain in a way that they have a fair amount, not only the privacy, but sort of the regulatory compliance to actually designate the on-chain asset, the actual legal asset. right? But still get that almost magical on-chain interoperability, with smart contracts and atomic settlement, right? And that's sort of the combination of features that I very strongly believe will allow them to do this, and that's what we're basically proving out in real time.
I absolutely get the efficiency gain of what you described there, and that's extremely important. However, from the first part, that there are certain asset classes which are not accessible, or they are already distributed amongst the ones which are buying them and sitting on them. I mean, that is just a fact. Blockchain, no technology in the whole world will ever change that. And either we create something on the side of it, and that's the new assertization or tokenization. Otherwise, I mean, the one thing has nothing to do with the other one. That's what I was confused.
I'm not quite sure I understand your question, right? We're very much a blockchain play. We're just saying, the industry has proven out over 10 years how to drive real financial innovation and new models and new types of assets. But we're trying to take that next step and say, how can we take non-crypto assets and actually get them on these rails as well?
I have one pressing question from the audience that I heard a lot. When is the ping pong starting? Tobias, tell us.
Yeah, I think we are very good in time. Obviously, the panelists are here as well afterwards for your questions and discussions. So, first of all, thank you very much for sharing your insights here. So we have a small gift as well, and it's especially useful because it's a racket for the ping pong, so you can beat everyone else with a special racket, right? So very important now, it's a great weather, great day today, so we want to move up one floor to the nice, beautiful terrace there. We have the ping pong tables ready. I hope most of you signed up to play. The tournament will start right away. It's managed by Sam. Sam, are you here to raise your hand? He's upstairs already. Arranging, so he will be waiting for you there. We'll play very short games so that it keeps engaging and we move forward. We have great food and drinks, so we hope to see all of you up there and follow us and the team upstairs now. Thank you very much for listening.
Thank you, Tobias. Thank you, everyone, for coming. And please join us on the third floor. We're moving right away as a team. Thank you. And there's going to be very good food and drinks.